The commodity markets are shifting, and the signals are stacking up. Welcome to Commodities Weekly Digest by Investing Angles, where every candle speaks, every Elliott Wave whispers, and we chart the turn before the herd even blinks. This week, gold flashes a rare technical warning we haven't seen in 45 years. Is history repeating? Silver stumbles on the weekly frame, but the final verdict isn't in yet. GDX Miners. A sharp pullback raises the question. Is a diagonal quietly unfolding? Oil continues its textbook bearish setup, steering toward a rare monthly event. Uranium. Bears fumbled their chance as the monthly chart builds a powerful case. Corn. Setting the stage for higher demand with technical patterns aligning. If you are serious about understanding the structure behind the moves, this is the place to be. And today we start with gold. The candle closure. On the daily frame on Friday, there was no surprising. After a confirmation of a daily top on Wednesday, gold tried to negate the candle and the formation, however, it failed. And on Friday, it formed a dark cloud cover. However, I'd like to say it requires a confirmation. Nothing is confirmed yet. A somewhat concerning candle is formed on the weekly frame. So if we look back, these type of candles are the most vulnerable for gold, and it is a possibility that it forms a spinning top or some similar candles. However, I'd like to say that this candle requires a confirmation. Now let's move to the next chart. I'd like to scratch the surface a little bit. So this is what's happening right now with MACD. Gold MACD reached its record level. It's almost 93 at this point, and this is the highest level ever. In order to find the next one, we'll have to roll back quite a bit, and this is, let me scroll back. So this is where the second highest MACD happened. It was in January 1980. And what happened then? We can just try and extrapolate. So this was the high, and if we measure the decline that happened after the previous record, we can see that gold lost about 68%, about 2/3 of its value over the next 5 years. It wasn't a straight line. There was lots of ups and downs, but nevertheless, the direction was quite clear. And this is what happened then. 5 years of a bear market. And by the way, it took, so let's flip to another slightly tighter chart. So, and one more measurement here. For those who bought at the top in 1980s, it took long 28 years to recover their price. This is just another technical aspect of what is happening right now. So now if we look at the current condition, what we are seeing, so the lower, this is the MACD, the lower one is for 1980s and the upper one is right now. So what we can see is a difference between them, I think at about 20%. Yes, close to 20% difference. And if right now we measure just the prospective decline, let's say it is aligned with something that we've seen in 1980s, I think that this would be quite shocking. If we measure it and try to check where it would be, oh, I need to scroll it because it's not enough. So if we look at potential decline of 68%, similar to what happened in 1980, 1985, well, this would bring us to this interesting price. So about 1100. So let's make it nice and round. So this is the perspective. Well, it's difficult, it's hard, it's impossible to believe in this type of thing. However, this is what technicals do, and this is what technicals help with. Well, that's the perspective. And if we add another 20% on top of this, so let's not even go into that area. So that's the perspective for gold. And mark this chart. Maybe it will happen the same path will happen. So now let's get back to more regular stuff. And this is Elliott Wave perspective. So what gold is forming right now? I think that it made a very strong impulsive wave up off the top, and it breaks like this. And this wave could be either wave A or wave 1 of a bigger impulse. There is a possibility that wave B or 2 was complete on Thursday, because this wave down, it also breaks nicely into an impulsive wave. However, at this point, I cannot reject the possibility of forming a bigger corrective wave B, like I outlined here in purple. So let's see what kind of wave it is. And I'd like to say that the wave upward here is more corrective than impulsive, particularly because of the very first wave here. And I'd like to say that the low here didn't surpass the low of April 23rd. Well, so there is a possibility of a slightly bigger bearish flag before we move down. Let's see how it forms, and we will update you on a daily basis. So now let's move on to the next chart in the gold section, and this is GOD, which we also usually track. So after a very strong bearish 5 gap pattern, we are seeing strong bearish engulfing, and the candles are moving down. However, it's not decisive yet, and we would like to see a much stronger reversal here, something that we can get on the weekly frame. However, the weekly frame didn't close with a very strong bearish candle. It is most likely an incomplete dark cloud cover, which requires a confirmation. So if the next week closes below the low of the previous week green candle, this would be it. So we are patient. Now let's move to the next chapter of our commodities presentation tomorrow, and this would be about silver. Let's see if silver is aligned with gold. So there was an interesting closure on the daily frame. Technically it's neutral bearish, but it requires a confirmation. I would drag very few chances for bears to continue, but at the same time bulls have not given up yet. Now if we look at the weekly frame, this is becoming very interesting. So we have 3 weeks of failures trying to negate this big red candle. Now there is a possibility, very strong chance, that this formation transforms into falling 3 methods. Let's see how it closes on the next week. It would be fairly instrumental. And on the monthly frame, there is a big decision coming on Wednesday. If silver loses about 1.5% and closes below this particular line, it will be a dark cloud cover and together with a very strong hammer. However, if it closes above, the bulls will still have better chances for the next months. So that will be a strong tug of war in the next 3 days. If we look at the chart, Elliott Wave chart, I already discussed that this potential wave is highly suspicious because it's very classical from geometry perspective, and I'm highly suspicious when they form like very ideal channels. Most likely, it will turn into be bearish flag. That's why I'm keeping this B and 2 potential counts along with the green one. So let's see how it develops here. So if we see a very strong move, particularly if it breaks below this level, then I would be looking for a very strong move down and potentially measuring this as a bearish flag. If we look at the bigger picture for silver, it's not decided yet. We've been discussing it for a while, and I think that the decision will come on the monthly frame with a candle. So far, silver didn't make a new higher high, and if it stays like this, there is a good chance it can launch a wave down. So far, the first wave of the top here in October was impulsive. Let's see if silver manages to make another impulse down. And if we look at the SLV ETF, there is a very similar formation on the weekly frame. The daily is kind of concerning because the 2 candles already failed to make a new higher high, and I would say it's a soft bearish combo right now, depending on the closure on Monday or Tuesday. The weekly looks like it is clearly forming an advanced block, the 3 candles, and together with the red one, it could be a very strong and powerful falling 3 methods. And I'd like to say that the 15-day frame has been bearish, and right now we are looking for another bearish closure in the next 15-day candle. The monthly, once we have a monthly frame, monthly print, we will discuss it on Wednesday. Now let's move on to the next chapter, and this is GDX Miners ETF. Let's see what is happening here. The biggest concern is the weekly closure. This is a very strong bearish engulfing, and there is a very good chance that miners will see lower prices next week. The question is whether it's going to be just a little deep to buy or it will be the beginning of something bigger. So that's and I think that the monthly frame can give us an answer, especially if it doesn't close above the high of the previous months. On the daily frame, it's soft bearish on the with the candles, and I'd like to say that looks like the miners are losing support of 8-day CMA. 2-day frame is not decided yet, but I'd like to emphasize that the weekly is very strongly bearish, and we will be looking for lower prices next week. This is the chart that we discussed earlier in April, saying that this possible ending diagonal is complete one way or the other. It's either the blue one or the green one of a bigger degree. Now the key level would be 36.26. If miners break through this, well, that's a lot of effort and a lot of drop. But anyway, this would be the key level to watch. Let's see how it develops. I would say that once it breaks through this level, it will be already a big concern. So this one, this is high 46.94. All right, so that's the perspective. It remains unchanged. Now let's move on and have a look at oil. What oil candles and technicals are telling us. So the daily closure, after a strong bearish engulfing, we had two failures, potentially consolidation candles on Thursday and Friday. Maybe we'll see another one on Monday, but the chances of moving lower are high. And if you look at the 2-day frame, we also have a strong bearish engulfing here. Now the candle will be, the next one will be closing on Monday, and it is yet to be decided. So the weekly failed to form a reversal here, and instead it formed most likely consolidation, bearish consolidation candle, and it get a rejection at 8 weeks EMA here. And speaking about the monthly frame, we've been talking about for a while. So the task becomes more and more impossible. In order to transform this bearish candle into a bullish one, oil needs to rally about 14.5% in the next 3 days, which is practically impossible. Now let's have a look at the Elliott waves. After forming an impulse down, which I consider either A or 1, oil consolidated for a corrective wave, either 2 or B, and it looks like this little wave down is an impulse, and now we are seeing this horizontal consolidation potentially forming wave 2. And once it's complete, we would be looking for a move down, perhaps a strong one. So far, there is no signal that could tell us about possible reversal here. So this would be the first target, 58.4, but I would be looking for 51.2, 47.5 in the next move. And if this is the lucky path scenario, if this is wave C, however, if it is wave 3 of a bigger impulse, we would be looking for lower prices, and we will discuss them in our weekly report with the members. Let's move on to another concerning part. This is the 4 months MACD, and so far oil moved and made this cross. However, for confirming it, it needs to hold for another 3 days below this level or close to this level. So it would be a very rare one, very rare technical event. It happened 2, 3, 4, 5 times only prior to that, starting in 1989. And if we look at statistical aspects of this this decline, this call, I would say that oil is moving towards the 50-30 dollar target in the next several periods, or technically it would be years. Let's see how it moves, and the average move would be about 77% of the most recent top, which is here. Well, now let's have a look at another technical chart that we discussed way back in January 20th, saying that oil is ripe for certain technical conditions, and this is a Brent chart, by the way, that Brent is ready for a big decline, and now it is continuously following this path, and at the bottom of her day move, it lost about 28% after the call. Right now it pulled back and is sitting as about slightly higher, 18% after the call, but the chances for moving lower are on the table and they remain significant. Now let's have a look at the monthly perspective closure for Exxon, Chevron, and ConocoPhillips. What we are seeing is very strong bearish monthly candles, bearish engulfing here, here, and here. Just a little projection for Chevron. In order to reverse the odds, it would need to rally about 18% just to make it less bearish. 18% in 3 days, it's virtually impossible. I think Exxon is in a slightly better position, so it would need about 6% in order to mitigate the bearish odds and make it somewhat neutral or even bullish candle. So 6% is very doable for a company like this in 3 days. And for Conoco, approximately, it would need about 12%. Well, that would be really hard. So I would say that Exxon is in better position, but Chevron and Conoco are concerning, and most likely they will close with very strong candles. But anyway, we'll discuss it once the month ends. Now let's move on to the next chapter, and this is uranium. And we will talk about energy fuels. So I'd like to say that this was an epic failure by the bears on the daily frame on Friday. So instead of closing just 1 basis point below the open, below the low of the previous green candle, they close it right on the same level. So technically it is considered as a bearish failure, and we will be looking for a continued move down. And on the 3-day frame, this bearish intent was cancelled with this green candle, most likely indicating a continued move higher. And the weekly frame formed a dark cloud cover. However, I'd like to see a very strong confirmation before making any calls here. What is very positive for energy fuels is that it looks like the monthly candle will be bearish engulfing. And what we can see here, so unless energy fuels lose about 7.5 or more percent in the next 3 days, the bullish candle will form, bullish engulfing, very strong one. And this is very encouraging. And if you look at the large perspective, this is something that we've been tracking since, where was the first chart here? Yeah, this one. So this is what we shared in December 2023, saying that energy fuels had a very good perspective. And this is December 19, 2023. This is where we made a call, and this is our target. You see that it's right in the middle right now, and it's potentially forming a very sharp move up. So, and I'm considering this as an ending diagonal. So if we look at the smaller wave, potentially energy fuels formed an impulse, which is wave 1. I'm looking for slightly bigger correction for possibly wave 2 and moving higher, which would be wave 3 in our case. So the next move could be very energetic and very interesting. Well, that's the perspective for uranium investors. And now I'd like to talk about corn. A few members asked about my perspective on this, and I'd like to share it with you. So the weekly, 10-day and monthly closures for corn. I think that corn futures are telling very interesting story that they are ready to move higher, and we clearly see that the trends are bullish on the weekly and 10-day frames, and the monthly is about to make a very strong decision. If it closes like this, slightly lower, slightly higher, better slightly higher, of course, and this would be a closure above the 200 months moving average, and at the same time as 50 months moving average. So, and it would be a bullish engulfing at the same time. So, it says that corn is about to move higher, and this is the chart, this is the perspective what I'm looking right now. It looks like corn formed a very clean impulsive wave, the first wave, wave 1 of the bottom in August 2024. Now we can consider this as wave 3, wave 4, and another wave would be slightly higher. This would be if corn completes it and moves higher. This would be a complete impulse. After that, I would be expecting several months of correction, to potentially forming wave 2, and after that we would be looking for wave 3. So let's see how it develops. Let's monitor it together, and it will be a nice ride once this setup, long-term setup, is complete. Well, let me wrap it up here. The commodity signals this week are loud, and history suggests that stakes are high. Gold and oil are setting the tone. Uranium and corn are writing their own stories. And the savvy trader knows the value of catching the turn early. Tomorrow, join us for the Strategy and Indices Digest, where we deep dive into equities, bonds, volatility, and sector rotations. It's another critical puzzle piece you won't want to miss. A special note, starting May 1, Investing Angles will begin offering premium educational services for deeper, more actionable insights. Early supporters will lock in the most affordable rates. The more we grow, the more we share. If you found today's insights valuable, subscribe, like, and share with your trading communities. Drop your favorite commodity ticker in the comments. Let's chart the next moves together. At Investing Angles, we chart the turn before the herd even blinks. Stay sharp, stay objective. See you tomorrow.